everyone, and welcome back to International Financial Management. In our previous lectures, we covered bilateral exchange rates, that is, the exchange rate between two specific currencies like the Indian rupee and the US dollar. But when we think about the country's overall currency strength or its trade competitiveness with the entire world, a single bilateral rate is not simply enough. That's where today's topic becomes very important. We are going to study two important concepts, and they are NEER and REER, where NEER means the nominal effective exchange rate and REER means real effective exchange rate. Let's start with NEER, the nominal effective exchange rate. Simply, NEER is a weighted average of countries' currency exchange rates against a basket of currencies of its key trading partners. Now let's break that definition into two important words. The word nominal. Nominal tells us that there is no adjustment for inflation. We are simply looking at the actual exchange rates as they are. Then the next word comes as effective. The word effective tells us that this rate is computed against trading partners, not just one country. So instead of saying, how is the rupee doing against the dollar, we ask, how is the rupee doing against all of the India's major trading partners taken together? This makes NEER as far more representative measure of currency's overall strength or weakness. Think in this way, if the rupee strengthens against US dollar but weakens against the euro and the Japanese yen, the bilateral USD INR rate gives you a misleading picture. NEER captures the net effect across all partners. Now let's look at the formula for NEER. NEER is equal to WI into EI upon EI base, where WI is the trade weight of partner I, that is how much of the total trade India does with that particular country. EI is the current bilateral exchange rate with the partner I. EI base is the base year bilateral exchange rate with that partner. The formula tells us for each trading partner, we compute the ratio of the current exchange rate to the base year rate, multiply it by that partner's trade weight and sum all of them. The result is indexed to a base year value of 100. Before we go into the numericals, let me briefly explain the concept of weighted average exchange rates and how the weights are actually assigned. India trades with many partners, some major, some minor. The USA and the European Union dominate, while others like Vietnam or Brazil have smaller shares. Simply averaging bilateral rates without accounting for these differences could be misleading. So, each trading partner's weight equals their share in India's total trade, that is, total exports plus imports with that country. Higher the trade with the partner, higher will be their weight in the NEER and REER basket. The Reserve Bank of India uses a 6 currency basket that include USD dollar, Euro, British pound, Japanese yen, Chinese yuan and Hong Kong dollar. The Bank for International Settlements, however, published NEER for 60 countries using a broader 26 currency basket updated annually. So, how do we interpret the NEER number? NEER greater than 100, which is relative to the base year. That means the currency has depreciated on average against its trading partner. The domestic currency is weaker. NEER, which is less than 100, which is relative to the base year, means the currency has appreciated on average. The domestic currency is stronger. A falling NEER trend over time tells us that the domestic currency is stronger against its main trading partners. For India, the NEER of the Indian rupee is published regularly by Reserve Bank of India and is closely monitored by policy makers, economists and exporters alike. So far we have been talking about nominal rates, rates that don't account for inflation. But here is a critical question. If India's inflation is 6% and USA inflation is 2%, now even if the rupee holds steady nominally, are Indian goods still as competitive? The answer is no, because Indian goods have become 4% more expensive in real terms. Foreign buyers will find Indian exports relatively costlier. This is exactly why we need REER, the real effective exchange rate. The REER is the NEER adjusted for relative inflation rates between a country and its trading partners. It measures the real purchasing power of the currency and gives us the true competitiveness of the currency in international trade. The word real is very crucial. It means we have removed the distorting effect of inflation differences between countries. REER in many ways the more important measure from a policy standpoint, because a currency can depreciate nominally yet remain uncompetitive in real terms if domestic inflation is too high. The REER formula is a natural extension of NEER, where REER is equal to NEER into price in India divided by price of the trading partner, or in a detailed weighted form, REER is equal to WI into EI into PI domestic divided by PI of foreign partner, where P India is India's price index, typically CPI or WPI. P partner is the trading price index of the trading partner. The ratio of price indices captures the inflation differentials. If India's price have risen faster than the partners, this ratio will be greater than 1, pushing REER above NEER. Intuitively, REER is equal to NEER into relative price level. REER interpretation is very intuitive. If REER is equal to 100, it implies that currency is at fair value. That is, it is neither overvalued nor undervalued. If REER is greater than 100, then it means currency is overvalued in real terms. Exports are becoming expensive. Competitiveness is declining. When REER is less than 100, then it means currency is undervalued in real terms. Exports are cheap for foreigners. Competitiveness is improving. The key insight from the difference between NEER and REER is NEER can fall, yet REER can remain high. If India's inflation is much higher than its trading partners, then REER will always remain high. In such a case, Indian exports remain expensive in real terms despite nominal depreciation. This is a classic policy trap, and REER help identify it. For the price index, there are two common choices: CPI based REER, which uses the consumer price index. This is widely used by RBI and the IMF, and it captures the overall price level in the economy. WPI based REER uses the wholesale price index. This is more relevant specifically for traded goods, since trade is largely about goods. WPI can sometimes be more direct measure. Now let's understand this with the help of an example. We have been given NEER, we have been given the CPI, Consumer Price Index of India, and we have also been given the CPI of the trading partner. There are two cases. You can see the NEER is same and the partner CPI is same, but the Indian CPI is different. So first let us calculate REER, and the formula for REER is NEER that is real effective exchange rate is equal to nominal effective exchange rate, we can say nominal effective exchange rate into the price in India divided by the price of the trading partner. Now here if we calculate it, it comes out to be 95, which is near given to us, into 115 upon 108. This gives us 95 into 1.0648, giving us the ultimate value of 101.16. So here in case 1, the value of REER is this, right. Now what does it mean? Now here REER is greater than 100. So it means that INR is overvalued. Now see, there is a difference. When we talk about NEER, when we talk about that NEER is greater than 100, we say that the currency is depreciated. Fine. And when we say NEER is greater than 100, we say that the currency is overvalued. Now if we consider our case 2, and then we will find that with the same formula we are going to use CPI as 112. We have 95 into 112 upon 108. So this gives us a value of 98.51. Now what does it shows? It shows that REER, as we have calculated here, is less than 100, and hence INR is undervalued. Now let us link REER to export competitiveness, one of the most practically important application. A lower REER makes a country's exports cheaper for foreigners, more competitive, leading to higher export demands. When REER is greater than 100, export becomes expensive. If India's price rises faster than trading partners, either due to high inflation or real INR appreciation, foreign buyers pay more for Indian goods. For example, Indian textiles cost $10 when REER is at 100. If REER rises to 110, the effective cost for the foreign buyers becomes $11. Indian textiles become less competitive compared to Chinese or Bangladeshi exporters. When REER is less than 100, export becomes cheaper. If the Indian currency depreciates faster than the inflation differential, Indian exports become cheaper for foreigners. This is precisely what China has been accused of. It is deliberately keeping its REER low to boost exports. China can keep its REER low if the nominal exchange rate depreciates or is prevented from appreciating more than the rise in the domestic prices. India's experience related to REER has generally been above 100 in recent years, indicating INR is slightly overvalued in real terms, partly because of India's inflation has historically been higher than that of its trading partner, even when INR was depreciating nominally. The RBI monitors REER very closely to balance export competitiveness against import cost and inflation control. Now let us first understand the question. India is trading with three major partners, the United States, Japan and the United Kingdom. The following data is available for the base year, current year, and we assume that base year index is equal to 100. So, we have been given the trading partner, that is the country, the trade weights and the base year rate along with the current rate, base CPI and the current CPI of each and every country. Now, what are you required to find? You are required to calculate India's nominal effective exchange rate. You have to also calculate India's real effective exchange rate. You have to explain what the difference between NEER and REER signifies for India's trade competitiveness. You have to state whether the rupee is overvalued or undervalued in real terms and why. Now, let us start with the first part, which is A, in which we have to calculate NEER. The calculation of the NEER is summation WI, where WI is the weights of the trading partners into the exchange rate of the current year upon exchange rate of the base year into 100. So, let us first see the contribution of USD, which is the weights is 0.40 into the current year exchange rate is 84 divided by 70 into 100. This gives us the value 48.00. Next is for Japanese yen, which is the weights of the Japanese yen is 0.35 into 0.58 upon 0.65 into 100. The value here comes out to be 31.23. Then we have to talk about the British pound. The British pound, here the weights are 0.25 into the current rate is 102 divided by 90 into 100, and this gives us 28.33. Now, let us add, because there we have this summation. Here we are going to add everything, and what do we get here is we get here 107.66. So, this is the value of NEER. Now, the second part is that we need to do the calculation for REER. Now, what is the formula of calculating REER? It is NEER into the price index in India divided by the price index of the trading partner. Now, here if we consider for USD, we have the NEER calculation. Now, here we will find the NEER. So, here it is going to be 84 divided by 70 into this price ratio, which has been given to us. This is 130 is for India, 35 is for India, and 118 is for USA. So, we will write here 135 divided by 118, and here the REER component is equal to 137.29. Now, we will go for Japanese yen. For Japanese yen, it was 0.58 upon 0.65, this particular value, and now we will multiply it with the price ratio, which is 135 divided by how much Japanese yen is there, 104. So, divided by 104 giving us 115.83. Now, we will do for GBP. GBP we have the ratio which is 102 divided by 90, this is the ratio that we are taking for near, into 135 divided by 115, which gives us 133.04. Now we are going to apply it with the weights and see the total contribution. So the weights assigned to us is 0.40, then we have 0.35 and we have 0.25, and we will multiply this value with this value, this value with this value, and this value with this value, and what do we get? We get 54.92 for USD, 40.54 for Japanese yen, and 33.26 for British pound. The total comes out to be 128.72. So that means this is REER, which we have got after adjusting for the inflation from the NEER figures. Now let us see now the C part. It is telling us that what is the difference between NEER and REER. Now here NEER is how much? NEER is equal to 107.56. It captures only the weighted nominal exchange rate movement. So it shows that rupee has weakened by 7.56%. Fine. Now REER adjusts NEER for inflation differential, and we have the value of REER as 128.72. It shows that in real terms the rupee is the rupee is 28.72% above its base year level. We got some competitiveness when we depreciated our rupee by 7.56, but we are still short of depreciating it more, and since we have not depreciated it to that extent, it means that our prices are very high and hence we are not very much export competitive. The D part asks us, is rupee overvalued or undervalued? Overvalued or undervalued? Now we know that REER value is how much? Is equal to 128.72, which is greater than 100. So we can say that rupee is overvalued. Fine. And Indian goods are more expensive. So we can say Indian goods are expensive. And hence exports are also expensive. While imports are cheaper, and this increases trade deficit. And this increases trade deficit. In the short run, currency depreciation may actually worsen the trade balance before it improves because import prices rise immediately, increasing the import bill, but export volumes take time to respond. Exporters need time to renegotiate contracts, scale production, and find new buyers. So the trade balance first dips the bottom of the J and then gradually improves the upward slope of the J. For India, these adjustments take typically around 12 to 18 months. This is approximately significant for India because a weaker rupee means higher crude oil prices in rupee terms. Higher crude oil prices increases fuel prices, which leads to higher production and transportation cost. This increases broad-based cost push inflation spreading across the entire economy. This creates a major policy dilemma for the RBI. Let the Indian rupee depreciate, let us boost export but raises the inflation. Control inflation by not allowing depreciation, then the exports are going to suffer. The RBI must balance export competitiveness against import cost management and inflation control, primarily through intervention in the foreign exchange market, buying or selling dollars as needed. NEER and REER are not just academic measures. Central banks like RBI use them as key policy tools to monitor competitiveness, guide intervention decisions, and assess the need for exchange rate adjustments. That's all for now. Thank you so much. See you in the next lecture.